Hey there, everyone. Today I'm diving into the conceptual framework and principles of generally accepted accounting principles, or GAAP. If you're a finance professional, you know how crucial these principles are for consistency and reliability in financial reporting. Let's get started. First up, the conceptual framework of GAAP. Think of it as the backbone of all accounting standards. It ensures financial statements are consistent, transparent, and comparable. The framework aims to provide useful financial information to investors, lenders, and creditors. Now let's talk qualitative characteristics. Two big ones here: relevance and faithful representation. Relevant information influences decisions, while faithful representation means the data is complete, neutral, and free from error. We also have the elements of financial statements like assets, liabilities, equity, income, expenses, gains, and losses. Recognition and measurement criteria ensure these elements are recorded consistently. And let's not forget the basic assumptions and principles like going concern, monetary unit, and economic entity. Now, onto the underlying principles of GAAP. These are the rules that help us prepare and present financial statements accurately. First, the revenue recognition principle. Revenue should be recorded when it's earned, not when the cash is received. For instance, a software company providing a service in December but getting paid in January would still recognize the revenue in December. Next, the matching principle. Expenses should be matched with the revenues they help generate. Then there's the full disclosure principle. All relevant information that could impact decision-making should be disclosed. For example, if a company faces a significant lawsuit, it must be disclosed, even if the outcome is uncertain. The historical cost principle is another key one. Assets should be recorded at their original cost, not adjusted for market value changes. So, if you buy land for $500,000, it stays on the books at that price. We also have the conservatism principle. When in doubt, choose the least optimistic view of the company's financial position. If collecting a debt is uncertain, record a provision for doubtful debts. The consistency principle ensures comparability over time by using the same accounting methods unless a change is justified. For example, if you use the straight line method of depreciation, stick to it unless there's a good reason to change. Finally, the materiality principle. Report all items that could influence decision-making. A $100 office supply expense might be immaterial for a company with $10 million in assets and can be omitted. In conclusion, the conceptual framework and principles of GAAP are crucial for accurate financial reporting. By adhering to these principles, companies provide reliable financial information, aiding stakeholders in making informed decisions. Thanks for tuning in, and until next time, keep those financial statements in check.